So we
Good
have Linda,
morning.
our amazing tax masters expert. She's our tax expert, but the name of her company is Tax Masters. That is in Rockville, Maryland. And I'm so excited because Linda and I have known each other for many, many years. We've been through, oh my gosh, we've been on television together. I think we're on ABC together. We have been on Sirius XM on my radio show numerous times. We've also been on many things together. And I'm so happy because I know your daughter too. And your daughter is amazing. She's international real estate. She owns a franchise down in Belize. So we've had her on. But Linda is the master for taxes, but you specialize in taxes for the entrepreneurs and specifically for real estate agents. And I know I've asked you this a million times, but it's always so important. Would you start with sharing a little bit about your story and how you became so in love? I think you're the only person I know who absolutely loves taxes.
That's right. It's because I started out working really hard like you as a realtor. I did commercial and industrial real estate. And that's really hard work. And what you do is even more difficult because it's residential. But at the same time, I was working part-time at H&R Block. I was still in college, actually. And I found out that the 3 months a year that I did taxes, that was really fun and easy because taxes, you can control them. Whereas the other 9 months a year when I was doing real estate, that's really, really hard. So as soon as I made enough money at real estate, because I used to sell office buildings and you only have to sell 1 or 2 a year and you make a lot of money. As soon as I put enough aside on real estate, I decided I'm not going to do real estate anymore. I'm going to do taxes, but I'm going to specialize in real estate. And that's how I met you, Jennifer, because at the time, of course, you're a realtor and you're licensed in at least 3 jurisdictions that I know of. Like Jennifer's all over the place. She's amazing. So that's my goal in life, is to help people who are involved in real estate, whether they're buyers, sellers, investors, entrepreneurs, mostly self-employed people. And that's my whole life has been spent doing that, and I love it.
And I know and I'll just want to brag on you just for a minute. I know you also have had celebrities. You also do international taxes. So you really work for those of us who work for ourselves, the entrepreneurs, and specializing with real estate. But again, the international side is something that a lot of times people just have no clue how to handle, especially if someone goes ahead and buys property somewhere else. So, oh my gosh. You just have had, again, all the sports players you have, and you've just had so many celebrities over the years. So you know how to help the humble real estate agent all the way up to the celebrities, right?
That's right. And we've got clients in over 30 countries. And lots of them are involved in real estate because they bought real estate over there, or businesses, or even some of them retired over there and they got tired of being retired. So they opened businesses, and a lot of them went into real estate. So it's all interconnected. That's my favorite thing to work on.
Well, and this is where I want to start with entrepreneurs. We're kind of a unique breed of people, real estate investors, real estate agents, because we work for ourselves. So one of the things that's really important, of course, is tax deductions. And so just because there might be someone not listening who doesn't understand, I want to talk about why a tax deduction is so important, how it can save somebody on so many different ways by having those tax deductions. So let's start with that basic principle, because before we go into all the tax deductions, and there's so many that are overlooked, and I know there's some new ones. So one of the reasons I put the title of this is the new tax laws of what you need to know as an entrepreneur. And it's so important. But let's talk first of all, why is for the self-employed, for the entrepreneur, for the real estate agent, why are tax deductions so critical?
They are critical because they save 4 taxes. Most of us, at least.
Taxes.
Yes, 4. If you have a personal deductions are very good. Personal deductions are things like money you've given to charity, or the mortgage on your home, the interest on it anyway, and the real estate taxes on your home, the taxes you pay to the state you live in. 43 of the 50 states have a personal income tax. So those folks have good deductions. They're fine. They save federal and state tax. But when you're self-employed, who's your boss? You are. So that means you have to pay your own Social Security and Medicare tax, which for everybody, the minute you make $400, it starts at 15.3%. Now, what happens is that that's added on top of the federal and state tax. So when you have a choice of whether having a business deduction, which saves you federal, state, Social Security, and Medicare, or just a personal deduction, which only saves you federal and state tax, it's a choice, 2 or 4, which is better? 4, you'd rather save 4. So this is why it's critically important for self-employed people to differentiate, or at least to know the difference between what would be just a plain personal deduction, which is good, but what's a business deduction, which is twice as good, if not even more than that. Because when you start adding up a federal tax rate, let's say you're in the 22% federal rate and you live in Maryland or DC, and around here, our tax rate is 8%, goes up to 8.75. And you add 22 and 8, well, that's 30. And now you add the Social Security and Medicare, which is another 15.3. So you're up to 45%. So do you want to lose 45% of your income? No, you don't.
No.
And the way not to lose it is to have business deductions. And I think later on, you're going to have me cover the 3 most overlooked business deductions for anybody who's self-employed. Doesn't matter. You could be a doctor, a lawyer, a painter. Anybody who's self-employed is entitled to those four kinds of deductions on their business expenses.
Which is huge. And that's where I want to start with that, because again, it's amazing how overlooked that is, that people don't realize that, business deductions are so critical, and understanding that. And so I do want to go to the 3 most overlooked, because that is critical. And again, it's amazing. And when I talk to people, sometimes they'll say, oh, I love my accountant or whatnot. And I'm like, okay, so I just want to ask you, and that's my litmus test of I ask, so I'm just curious, and I'll ask one of those 3 because I know them so well, because I know you, Linda. So let's go ahead and, but before we do that, let's talk a little bit about what's new in some of the tax deductions. I know that, with all of the stuff that's happened with the pandemic, there are a lot of different, I want to say nuances, because there's always changes every year, right? I know you guys have to get updated every year on what's getting changed, but will you talk about the fact that some of the things that people should know as they're thinking about filing? Because right now we're in March of 2022. So if you're watching this at a different time, we always date ourselves when we talk about taxes, because there's always something new or something that's changed. So right now we're in March of 2022, and what is new that people need to know?
Well, for those who are self-employed, one of the biggest things is that Congress actually wanted to help the restaurant business because it suffered so much during the pandemic. It's still suffering, actually. Many of them have been closed, unfortunately. So what they did was they're allowing business meals to be 100% deductible. Now, in the past, they used to be 50% deductible, sometimes not deductible at all. But this year, starting January of this year, 2022, you can deduct 100% of your business meals if they come from a restaurant or if they take place in a restaurant. So what this means is if you have a lady and she cooks a lovely dinner and invites people over, and all of these people are her clients or prospective clients or referrals, she served the meal in her home, the food came from the grocery store. So it is a business meal, but it's not a deductible business meal. Whereas if she buys the food at a restaurant and then brings it home and serves it, then it is a deductible at 100%. Now, 100% deduction saves you how much? Federal, state, Social Security, and Medicare. So this is very important to know. Now, it was allowed at 50% rate last year. So that meant that, let's say last year you took some clients out to dinner, you had a lovely meal, a couple $100. So if you spent $200, you were only allowed to deduct $100. But this year you spend $200, we're going to deduct $200. And like I say, if you have at least the 45% bracket, which most everybody who's self-employed does, that saves you $90. In other words, that $200 meal, when you file your tax return, the minute you sign your return, the Internal Revenue refunds to you by way of taxes, lower taxes, $90. So the $200 meal only cost you $110. Oh, not bad. So this would be the year to entertain your clients. And restaurants also include bar bills. Many of our clients are single, and our single clients, they spend a lot more in bars usually than our married clients. But in any case, bar bills, restaurant bills, and even if it's takeaway or bring home or delivery or whatever, you have that pizza you have delivered to your house, and you've got friends over there, and maybe half the friends are personal and half of them are business. Well, then you can deduct half of the cost at the 100% rate. Does that make sense to you, Jennifer? Isn't that good? That's new this year, January this year.
That's new, and that's great, because obviously, as you said, the restaurant business, and in Washington, D.C., we've seen it. I mean, it rips out your heart a little bit as you walk or drive. In Georgetown, it's amazing as well. But all over Washington, D.C., we've seen restaurants just really didn't make it through the pandemic. So many of them, their profit margins were so thin and they didn't make it. So it's nice to see that this is one of those ways that Congress has decided to help, especially to help the entrepreneurs, because the time of bringing somebody, I remember when I first got into, I can't believe I'm going to say this, 25 years ago, when I first got into real estate in Washington, D.C., it was rare that you would have a client meet you in some other place than your office. They traditionally would meet you in your office. Now, people all the time, if I'm signing a contract, if we're going over, any other aspects of a home inspection or some kind of part of the contract, they always want to meet somewhere other than the office. They want to meet in a coffee shop, or they want to at least go have lunch, or, whatever. But so we often are meeting somewhere else. And again, that is the expense that they assume the real estate agent, the entrepreneur will pick up the cost of all of that. So it's nice that Congress has not only supported the restaurants, but also is supporting, with this kind of tax break, really supporting entrepreneurs for what we're doing. And again, because we're traditionally not in our office as much as we used to be, we have all of these wonderful electronic and other means.
And the salesman always pays. My third husband, he was wonderful. And he was involved in sales. He dealt with coal mines and things like that. But I used to complain when the American Express bill came in. There was this huge, we'd be entertaining at the Palm and fancy restaurants in Century City or New York or Washington. And I said, "You're spending too much money on entertainment." He said, "You have to remember something. The salesman always pays." But this could be little things. Jennifer, how many times have you been out showing properties and it gets to be lunchtime or later than lunchtime?
Yep.
So you stop at Panera's or you stop anywhere. Well, that's a restaurant. So now everything you spend at Panera's or wherever it is, that's deductible. And by the way, if you spend $75 or less, you don't even need to keep a receipt, because for any business expense that's $75 or less on each occasion, you just need to write down the date you spent the money, the amount spent, and the business reason. So let's say you're out and you didn't get the receipt or you're in a hurry, you could write down Panera's business meeting or showing of property, and the date and the amount that you spent. And if it's 75 or less, that's all you need. Now, of course, you want to make that notation in your iPhone or your somewhere on a piece of paper somewhere that you'll remember it at the end of the year. But that could be $75 once a week or twice a week, whatever it is. That's all deductible. And how much do you get back? Well, you're going to get back about 45% of that, whatever you spent. So it saves you so much money. I mean, if you just spent $90 or let's say we spent $70 a week and divided that by half, that's $35. So you're saving $35 a week just by having one meal that you paid for your clients.
And you think about that $30 a week times, like, just say 50 weeks. So not 52, just because you'll say you take 2 weeks off. That's a lot of money.
It could be Starbucks too. When I say restaurants, I mean eating establishments. So even if you just drop in and you get some lattes or mocha mix 2%, I don't know what they have, whatever that is. And it's always less than $75 unless you're feeding a lot of people. So please keep that in mind, because it's new this year and nobody knows what will happen next year. So we should take advantage, do lots of entertaining this year.
So, and it wasn't for 21, it was only for 22. Is that what you're saying?
That's right. For last year, you were allowed to deduct 50% of your business meals, but this year it's 100%. Now, when I say something's when I say something's 100% deductible, that doesn't mean that you get back 100% on the tax return. It means that you get to deduct 100% of what you paid. And then the amount that it saves you depends on your federal bracket, your state bracket, and your Social Security and Medicare is always 15.3%, unless you make more than a couple of $100,000 a year, and then it goes down to only 3%, 2.9. Yeah.
So that's really important. Again, I appreciate you always going back to the basics like that, because so often I think we overlook the different ways that we can be looking at our expenses. And one of them, as in real estate, often is also staging. With an open house, a lot of times we do the same thing. And even like you, when you come to the studio at Sirius XM, you would bring me muffins, or you would bring, I should say, all my staff, the producer and the board operator and all those folks. And those are the business deductions as well. And I think that's a really important one. If you'll talk a little bit about some of the things I think that we forget, but we're still spending that money in real estate on stuff like that, staging, also, yes, bringing food to an open house.
Yes, and absolutely. I love when you mention staging, because, we do taxes for over 2,000 realtors, probably 2,200 realtors. And we find that the ones who have expenses for staging, percentage-wise, they make much more money than the realtors who don't do any staging. I think, as a realtor myself, and I'm still a real estate broker, I'm not in competition with you. If I have any clients, I'll send them to Jennifer. But the realtors who do staging, they make so much more money percentage-wise, because just by staging the property, it makes it look more attractive. And especially if it's empty. As you know, selling a property that's not empty is more difficult. But
I agree. I have an entire online class about staging, because it's amazing to me how many real estate agents resist it. And yet I'll tell you over and over again, we can show so many statistics on, a house sells faster when it's not vacant and when you can stage it. And there's even virtual staging. There's always a way to do it. But and the virtual staging, again, is another business deduction, right?
Yes. But basically anything that you spend money on that helps you make more money is a business deduction, unless it's something illegal, which we won't even go into. But
okay, I'm going to go completely, let me give you a totally random question, not real estate, but my sister recently asked me this question, and I was like, okay, I know I seem like the expert, but I am not the tax expert. We're going to have to ask Linda. She's the tax expert. So she has a store on Etsy, and Etsy is her online business. And what she does is she has a lot of these beautiful antiques that she sells. She finds them in, estate sales or yard sales or different places, and then she sells them. Well, she has to put her hand in there to hold things all the time. And then they take a photo, and then it goes up online. So
manicure.
Yes.
Yes, because it's necessary. Because if she had an unmanicured hand, I'm sure her hand is very beautiful, but it looks better if it's manicured. That's like an advertising expense. So absolutely deductible. Absolutely.
Okay, good. That's what I thought. So I'm going to tell her the good news.
Yeah, and tell her to send me her website. That sounds interesting. Oh my goodness, you have such an interesting family. I love your brother that you share with me, and your dad, and the sister too. Oh boy, I got a bigger family now.
You'll love her Etsy story. It's all antiques. It's really neat, and she does a lot of research on this stuff as well. And anyway, so I'm sorry, I digress. But the reason I wanted to say that is because, again, I think so often people overlook all the different deductions that they can have. And I just think it's really important that, number one, you also made a point that is also, I think, often overlooked, and that's is it $70 or $75? If there is an expense that you don't have a receipt for, but it's under how much?
$75 or less. And this could be many on one day. For instance, let's say Jennifer's going to do an open house this weekend, and let's say the house is already vacant. So the first thing you're going to do is you're going to stop at the grocery store and pick up some toilet paper, because as we all know, vacant properties always need toilet paper.
I know.
And maybe some nice spray to make it smell good because it's been vacant for a while. And maybe some Windex because you want to clean the front windows, make them look pretty. So you have this long list of things you bought at the grocery store. 90% of them are for your home, but 10% of them are for your open house. So you just write down $60 open house expense, groceries, that's it. Now you get to the open house. Oh my gosh, the disaster of the yard and the garage. So you have the little boy next door come over and you give him $50 and he mows the lawn. Or and today, where right now it's snowing, he shovels the snow, and he cleans up the garage. So he doesn't have a receipt to give you. So you write down $50, boy next door, clean up the open house. Okay, and that's it at the date. So now at the end of the day, you've spent $110. Can you deduct it? Yes, because each occasion, each item was 75 or less. So that $110, it's going to save you at least $50 income tax. So good grief, if you keep track of all of those, and this goes on for a year. I have one client who's a realtor. She gives the little boy next door $50 a week, and he comes over and he details her car, and she likes to have her tires and wheels cleaned. And we deduct $50 a week times, as you say, 50 weeks for her car expense. No receipts necessary. So it's really important, because how many taxes does it save you? Come on, everybody. Here, pay attention.
Yep, we should do that. And I'm going to take out my magic wand. This is a magic wand for anyone who's watching on YouTube. The magic wand is the wand that actually Linda brought me so that we can remember we would like to have taxes disappear. So we have a magic wand to help them disappear. And so for taxes, so knowing your business deductions is really critical, being an entrepreneur, being a real estate agent, being a real estate investor, really understanding those. So I want to go over these three most overlooked tax deductions, but we already have a question, and I wanted to go ahead and honor Lily, because I know everybody's, you never know with Clubhouse, the people pop in the room and pop out of the room. So I see Lily, you've got your hand up. So I'm going to go ahead and bring you up to the stage. If you would like to ask a question, Lily, you got the floor. Would you like to ask a question to Linda?
Yes, I would, and thank you for inviting me up. Recently, I own a 3-family home, and recently I turned one of the apartments into a nurse B&B. This is the first time that I've done this. What I'd like to know is this. Many times they ask us to create what is called a welcome book, right? Mm-hmm. And I've done so, but there are certain places that are nearby my property that I've never been to. I'd like to know if I visit those properties and then put them in the welcome book, would that be considered my cost of admission to that place? Would that be considered being tax deductible?
I would think that would be a reasonable deduction, because it sounds like something that's going to help you sell the property. And it's not something you're doing voluntarily. You might be visiting a sewing machine factory or something that you never would visit otherwise. Now, of course, if you have a meal there or something like that, maybe we wouldn't be able to cover that. But it's also possible, if you took somebody with you for that meal, that it would become a business deduction, because perhaps they're a possible referral. You know, in real estate, everybody is buying or selling a house, or they know someone who's buying or selling a house, or they're a possible referral, like I said. So with real estate, you have a lot more leeway than if you're, let's say you're a doctor who's an orthopedic. Well, you're going to need to find someone who has a bone problem, and that's your specific target. But with real estate, almost everybody is your target. So make sure your accountant is aware of all of these things, especially the new laws. And then, of course, the old laws, too, because there's some laws that have been around for many years that a lot of accountants don't even know about. I teach accountants, so this is how I know that they don't know them.
Yeah. And you teach continuing education for real estate agents in Washington, D.C., Virginia, and Maryland, because I'm licensed in all three. Yes. And I am so happy, because I love taking your class, because they're always so funny and fun and enthusiastic. I mean, that's how I have a magic wand. And you bring all sorts. That's the reason when I first met you, I thought, who in the world is this person who loves taxes and loves teaching about taxes? And it warmed my heart so much, because I love it when someone was that enthusiastic about what they do. And I know it keeps you up at night. What's the new tax? What do we need to know? And even before this interview, what's the best things we can teach? What are the things that people need to know? And I love that that now for 2022, we definitely can take all those business meetings and we can go back to restaurants. I think encouraging people to go back to restaurants is a beautiful thing. So Lily, do you have another question? Or
That was a very good question, by the way. Never had that one before.
No, that's perfect. I know I saw you clapping. Thank you for clapping, and thank you for being here. And definitely raise your hand again if you've got more questions. I'm going to go ahead and ask you one more question, Linda, about Airbnb, just because Airbnb is, I have had Airbnbs over the years, and I think it's one of those that, again, we're always looking for how can we, let's review quickly, because I think for so many people, this will be a blessing. So Airbnb is short-term rentals, and there's all sorts of things that are unique about it, including the fact that you're constantly having to update things like light bulbs and toilet paper, and sometimes you're required to have shampoo and condiments, so you might have to mustard and ketchup in your refrigerator. And I used to love, like, I'm the person who always thought it would be so much fun, period, to own a hotel. So I used to always bring a dozen eggs and coffee and tea, butter and milk, like the basics, so somebody could make breakfast and have coffee and tea when they come. And I can't tell you how many people told me, oh my gosh, my flight arrived so late and we didn't have our luggage, or we didn't have blah, blah, blah. And being able to have the coffee and the tea and the milk, and of course, toilet paper, paper towels, things that you don't really think about. But again, when you have an Airbnb, they're just like, they're gold for somebody who comes in. And I'm assuming every one of those is a business expense, right?
Absolutely. Absolutely. It greases the wheels. And this makes it easier for people to give you a really good rating, and which of course will bring you more business. And also, I'm sure if they come back to town, they're going to want to be at your location also. And you sound like the wonderful, wow. I always want to stay in your places.
Yeah. I used to have this addiction to breakfast foods, of making sure that people had this whole variety, because as you know, one of my favorite places, I think we can say anything we want here. Trader Joe's has these amazing croissants, which, I'm gluten-free now, so I don't eat the croissants, but you put them there from the freezer. So you take them out, you thaw them, and then you bake them, and they rise, and muffins and all sorts of stuff. So now I just do eggs and milk and coffee and tea, but still, all of that are tax deductions. Yeah.
Absolutely. It makes your business more important, and it gives you the good ratings for future business. So you've accomplished two things.
And David was just saying, I'm sorry, I didn't see your hand, David. Yes, absolutely. You've got a question. So David has a question for you.
Yeah, hi, Linda. David Randolph. On short-term rentals, following up with the expenses, is it a short-term rental isn't considered passive income, right? So the income from those are FICA taxable, is that right? How do you handle the income from that versus a normal one-year rental? Could you talk about the tax implications?
She's going wild, David. You just wait.
Yes. It's active income. Why is it active? Because first of all, it's short term. It's 1 week or less. That makes it short term. And also because you're providing certain services, perhaps towels or cleaning the laundry or leaving supplies like Jennifer mentioned. So if you just have a home or a house or something or a business and you rent it out for 1 year at a time, that's completely passive, and it goes on Schedule E like elephant, and no problem. But the minute you do short-term rentals and you provide also a few little services, you don't have to, but you do, then it's considered active income, and it doesn't go on Schedule E, it goes on Schedule C. Now, the difference between those two schedules basically is the fact that Schedule E is only subject to two taxes, federal and state, whereas the Schedule C income is active, it's working, it is subject to federal and state and Social Security and Medicare. So now you just graduated to a higher tax bracket, and you're saying, oh, maybe that's not so good, it's going to be more tax. No, don't worry about it. Now you have more deductions because you can deduct driving back and forth to there. You can also use that income to put into what I'm going to talk about in a few minutes, is your solo 401k retirement plan. So income from passive rental, like that 1 year term, is not allowed for putting into a retirement plan. So, but if you have short-term income, that's active. It goes into a retirement plan if you want to, and that comes off the top of your income. So if you put any money into the retirement plan, but only the one that I like, only the qualified one, okay? Don't do those. Don't do a SEP. Don't do an IRA. No. only do the one I want you to do, which is the newest one, it's 20 years old, then that one is going to save you all the federal tax, because for a dollar, every dollar you put into your solo 401k is fully deductible. Okay. Plus, there's a new deduction, which I haven't even gotten to yet. It's called the 20% deduction. So for people who are self-employed of any kind, there's an automatic deduction of 20% of your net profit. And sometimes that's allowed on rental income too, but you have to qualify it. But in any case, usually on rental income from normal long-term rentals, you usually show a loss anyway. But from profits from businesses, there's a 20% deduction and the retirement a deduction if you want to make the retirement contribution. So very good question. Thank you.
Thank you. So then would we use a S corporation for this then?
Okay, you can use an S corporation. I always like to start out at least with an LLC. That's a limited liability company, because that way, in case something goes wrong and you were to get sued, at least you've built a brick wall around your assets with an LLC. And then you can go from there, and your accountant will tell you, don't ask a lawyer, ask an accountant. And I don't have anything against lawyers. My daughter's a lawyer, and the first thing she'll tell you is to talk to your accountant. Let your accountant decide if you're making enough money to warrant an S corporation. Usually, if you're making less than 150,000 net in your pocket, then it's not really worth it, because with a corporation, you have to do payroll. You have to hire yourself as an employee, which means you have payroll for yourself and anybody you hire, of course. And you have to do the bookkeeping. You have to do the payroll bookkeeping. You have to file a separate tax return. And it's quite a bit more expense and bookkeeping requirement. Whereas if you're just self-employed and you're just a plain little LLC, you still have the protection, but you don't have all the extra bookkeeping costs or requirements, because it's not just paying for the bookkeeping. It means you're required to keep the books, and you're gonna have to pay someone to do it if you don't want to do it yourself. So be careful with that one. I like schedule, I like LLCs, I like subchapter S's, but only for certain clients.
Very good. David, was that helpful for you?
Thank you, Linda.
You're very
Awesome.
welcome.
And you guys can ask more questions. I'm going to go ahead and have Linda talk about the 3 most overlooked tax deductions. So that's our next phase. And these are the ones I love, these 3, because again, as Linda talks about, she's got her magic wand out now. This is really important that you realize so many accountants don't know this. And it's beautiful because Linda actually does continuing education for a real estate agent. She also teaches other accountants. She has firsthand knowledge on how many accountants do not know of these most overlooked tax deductions, and they've been around for a very long time. So with all due respect, there's no excuse for not knowing these and you not taking advantage of them, because they actually do really result in money in your pocket. So Linda, what are the 3 most overlooked tax deductions?
Okay, well, first we'll start. These aren't in any particular order. I'm just giving them to you in the order that they're on the tax return, because that's how I remember everything. The first one is claiming an office in your home. You know, in 1999, Congress completely changed the law. Before 1999, it was almost an automatic audit if you claimed office and home, because under the old law, you had to have a separate entrance for your clients to use. You had to see clients at your home office 5 days a week. You know, maybe you ran a dental office out of your office or something. So that was different. But now what's happened is, since 1999, the only requirement that you need to fulfill for claiming an office in your home is you need to have a space in your home that you use regularly and exclusively. It doesn't need to be a separate room. You don't even need to own your own home. You can be a renter. You could even be renting from your parents or somebody else. But in any case, if you have a space in your home that's used regularly and exclusively, and by exclusively, I don't mean using the dining room, except that once or twice a year you have Easter dinner or a Passover dinner or something there. This has to be a room that nobody else uses. Your children don't play computer games in it or anything else. So if you have such a space, measure the space, measure the whole entire amount of the home, figure out your business percentage. For our realtors and most self-employed people, it's somewhere between 6 and 10% of their home. And I know that doesn't sound like a lot, but here's what it means. Because business expenses, since they save you for taxes, if you can take 6 to 10% of your home mortgage and move it from the personal part of your return over to the business part, you just save double taxes on that amount. Also, the real estate taxes on your home. And when you have a home office, you also get to deduct 6 to 10% of your utilities and your condo fees, HOA dues, repairs, everything that it takes to keep your home running, okay? Now, when you go to sell the house, you do not pay any tax on the gain when you sell the house like you used to do under the old law. And not only does claiming an office and home give you all those wonderful business deductions, and I'm explaining business is the important part, is that it also allows you to claim more car expenses. When I do the shows with Jennifer, I would get up on a Saturday morning and I go to get the donuts or the muffins and then drive from my house in Bethesda, Maryland, down to Eckington Place Northeast, okay? That trip was deductible because I was leaving from my home office to go to Jennifer's workplace, which is Sirius Radio. And then I would drive back from Eckington Place Northeast to Bethesda, Maryland. All deductible because I had a home office. If I didn't claim a home office, then that entire round trip wouldn't have been the least bit deductible because it's considered commuting. Commuting is when you leave your home to go to work. So those are never deductible. So if you have an office in your home, not only do you get the extra office and home space, you also get all of your car expenses for those extra trips. So if you're a realtor or an insurance sales or a doctor, a lawyer, whatever, and you don't have an office in your home, then don't try to tell Internal Revenue that you used your car 80% of the time for business, because they're going to say, wait a minute, you can't deduct commuting expense, therefore 80% of your car expense can't be deductible. You will get audited. So in the old days, you got audited for claiming office and home, but after 1999, that's when the law changed. I helped get that law changed, by the way, thanks to me and some of my clients. Yes, I beat on some of my clients that were congressmen and representatives. I said, you fix this law or else you won't get a refund next year from me. So that's the new law. So that's takes care of office and home. So the second most overlooked tax deduction, it's been around since 1955. So don't tell me that your accountant has never heard of it, because that means they haven't read any tax laws since 1955. And this is a law that allows self-employed people or people that have little companies to deduct all of their medical bills as a business expense. Now, normally, can you deduct medical bills? Say no.
No.
No, very good. I love obedient clients. Thank you, Jennifer. What happens is if you have only personal medical bills, which usually everybody does, they're only deductible to the extent that they exceed 7.5% of your income. So let's say we have a married couple. She makes $50,000, he makes $50,000. So together, their total income is $100,000. Well, 7.5% of that is $7,500. So if that couple happens to have $8,000 worth of unreimbursed medical, such as insurance and glasses and dental and things like that, then how much do they get to deduct? Only the amount that exceeds $7,500. That's less $500. So out of $8,000, they only get to deduct $500. And most people don't spend 7.5% of their income on medical, much less more than 7.5. So all lost. Those are totally undeductible medical expenses. But the minute you become self-employed, you can hire yourself. You say, you know what? I'm head of my own company. I think I'll hire myself. And as the head of my company, I deserve some benefits. Let's see, let's write this down. I should be able to deduct my car. Yep, let's write that down. Oh, I should be able to deduct my medical bills. Yep, that's fine too. So at the end of the year, all of your medical, 100% of what you paid for insurance, glasses, co-pays, long-term care insurance, dental, anything that wasn't covered by insurance is completely deductible as a business expense, which saves you how many taxes? For tax.
For taxes. But let's,
Yes.
Linda, explain a little bit more about that. So what do they need to do to make sure that they have done that properly so that they can 100% deduct all of their medical expenses?
Yes. Well, if you're single, you'll need to, we will need to make you become a C corporation. And as a C corporation, what will happen is when you receive a medical bill, you just pay it out of the C corporation. So it comes right off the top of your income. If you can do that, whether you're married or single, by the way.
So you can't do that if you just have an LLC, right?
Well, you can have an LLC, but you'll need to elect to be taxed as a C corporation. So yes, you can have both. Now, if you're married, you can also elect, forget the C corporation, forget anything. I'm just self-employed. That's fine. Fine. Then you'll hire your spouse to help you. And this happens very often. I would say that 90% of the time, our ladies who are married, who are involved in real estate, of course, their husband runs around and he ends up pounding signs for the open houses, and he'll end up going back and collecting the signs at the end of the day. And I'm sure she'll send him out to deliver things, or to take messages, or to send faxes, or to deliver.
Or you forgot
something.
The toilet paper for the open house. So you send your husband to the store to go get, hey, I need you to go get toilet paper and get it over here right now.
Yes.
The open house.
My poor first and second husbands, they both had to do all that for me. But in any case, that now you've hired them, and you need to give them a little salary, about $300 a month. That's all you have to pay them. And I know they're worth much more than $300 a month. And of course, your spouse can have lots of jobs. I have a client whose spouse is one of the directors at the World Bank, for heaven's sake. But she hires him, and we give him $300 a month. And then you can deduct all of the medical expenses. What you do is, when you hire the employee, your spouse, you say, I'm going to cover all your medical expense for you and your family. Well, who's their family? Well, your spouse's family happens to be you and your children and anybody who's your dependent. So now all of those completely non-deductible personal medical expenses, we just took them out of the trash can and we've taken them up here, and now they become fully deductible business expenses. So all those expenses just went from saving you 0 tax, not even 2, they saved you 0. Now they're going to save you 4. That is actually the most overlooked tax deduction for anyone who's self-employed. And it's been around since 1955. You don't know how many times I have new clients who come to see us. And, you know, we have over 3,500 clients, 3,500. And I would say that 100% of all new clients we get, they've never heard of the law, which isn't their fault because it's not their job, but their previous accountant never heard of the law because they don't specialize in self-employed people, okay? So that's the second one. And the third one.
Wait a minute, before you go on to the third one, let's talk about that just a tiny bit more. So, because again, that one, you're talking about literally your eye exams, you're talking about your dentist, you're talking about all of the things that I hate to say every one of us have, but again, usually can't deduct it. And then, right? Yes.
Anything that's unreimbursed. Now, sometimes our realtor ladies, they have a husband, like I said, the one who's the husband at the World Bank. He gets free health insurance at work, but the health insurance doesn't cover everything. There's always co-pays, and usually nothing covers glasses and dental and things like that. So you can deduct all of that, including your trips. I just had a new realtor client who comes in now. I don't actually do returns anymore. My son, Preston, who runs the company, he takes care of them. But I ended up speaking to this lady because she's a friend of a friend. And she has twin boys who are both going to be getting braces. And she was just about to write a $5,000 deposit check to the orthodontist for the braces as a down payment. And we told her, don't write the check. First, we're going to hire your husband and give him a little $300 a month. And then you write the check to the dentist, which will become fully deductible. And she's going to end up spending thousands of dollars for her twin boys. So, oh my gosh, we got her just in time.
Well, and I think that's really important. And so when you set up the $300 a month for the husband, do you need like a bookkeeper who keeps track of that $300 a month, or how do you prove that?
We do it automatically. I think Marty Wapner in my office has set up more of these more of these employee business plans than anybody in the United States of America. My company, I've been doing them now for 40 years. We set up more of these medical reimbursement plans than anybody else, and so we do it for you. I think it's about $800 the first year to set everything up, and maybe $500 a year thereafter. So we handle it all. We handle, paying the paycheck and taking out the taxes, because then you do have to take out a little federal tax and a little bit of Medicare and Social Security tax. It all has to be done properly, just as if you were hiring a stranger. It just happens that this person you hired is your spouse and you love them and you want to give them all of their medical bills as a reimbursement. Aren't you a good boss?
A good boss.
Yes, and the wives, they can take their husbands out to dinner and talk business. They can take their husbands on real estate conventions and talk business, or their partner, whoever it is. My daughter Macarena, she has a wonderful partner, Yvette, and when they go out, and if they're talking business, it's deductible. And if it's at a restaurant, it's 100% deductible.
That's
Yes.
awesome. So, and what about for other family members? I know you said you can hire children. What about hiring a parents or a sibling?
Oh, yes. I had a lady who was a realtor who every month she was paying $800 or so per month for her mother's prescriptions that weren't the part that wasn't covered by insurance, because the mother hadn't even reached 65 years old. So she wasn't even on Medicare. And I said, well, does your mother ever help you with work? She says, oh my gosh, my mother makes my schedule, and she takes care of things. And if I'm entertaining, she'll cook all the food and everything. So I said, we need to hire your mother. So we hired the mother, and we put her on her little paycheck for $300 a month. And you know what happened?
What?
Within 6 months, the mother took her job really seriously, and she would go and get her hair done and her nails done. We couldn't deduct that. But the mother lost about 50 pounds, and she didn't need to take the medication anymore because no longer was she diabetic. So it worked out absolutely great, because mom was living with her and she was a full-time secretary, and mom was very serious about her job because now she was getting paid to do this. So the $800 that we originally needed per month for the medication disappeared. But when you have an employee, now you can put money away for their retirement. You can give your employee a cell phone, that's deductible. You can reimburse your employee for use of their car. Like many times the employee, the husband or whatever, or the mom is going out and delivering things or pounding signs or whatever. So it's very, very nice. And I had one lady realtor who, the real estate convention was coming up. We have it here in Ocean City from time to time. I always speak there. And she said, well, now that I've hired my husband, does that mean I have to take him to the real estate convention in Ocean City? I said, you can, and he's deductible, but you don't have to. She said, no, I don't want him there. I have more fun without him. So you're the boss and you get to decide. You can give your employee a turkey at Christmas time and deduct it.
And you also mentioned long-term care. So there's life insurance that you can purchase that has long-term care in there. And that is also a tax deduction, but only if you have this medical reimbursement plan.
That's right. That's right. If you have the medical reimbursement plan, you can deduct the long-term care for you. If you hire your spouse, you can deduct the long-term care for your spouse. It's all of your family's medical. So even if you haven't hired your spouse, you can still deduct the long-term care for your spouse, because that's part of your family and you're the employee. So all of these things, and you can also deduct life insurance on your employee. Okay. Things that would never be deductible otherwise without the medical reimbursement plan. And if anybody has any questions on this, if you go on my website and just contact Marty Wapner, he's from New York. You'll love his New York accent. Marty sets up these plans. And like I say, I think it's $800 for the first year and maybe $500 a year thereafter, which includes everything, including the payroll. And that $800, is it deductible? Yes, the $800 is deductible. So you're going to get back $400. So it really only costs you $400 out of pocket. And now you can deduct thousands of dollars in medical bills. What is there not to like about that? Yes.
Exactly. That's why I wanted to continue to keep asking about all the things that are deductible under that. Because as entrepreneurs, I think that people get surprised, just like I was asking that question for my sister earlier. It's amazing how their accountant will say, no, you can't do that. I'm like, well, wait a minute. I think you can. But again, the thing is you didn't do the medical reimbursement plan. You didn't set up the proper tax or whatever structure and legal structures that you need, whether it's an LLC, a C Corp, an S Corp, as we've kind of, gone through this. And I know we're running down to our last couple minutes, and I want to get to the third most overlooked tax deduction. But I also want to say for everybody who's in the room, everyone who's in the audience, if you guys want to raise your hand, feel free to raise your hand. We'll pull you up on stage and you can ask questions as we go through this last little bit with Linda. So Linda, here it is, the most overlooked tax deduction. Dun, 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 dun.
Yes, this is a law that was passed in 2001, so it's not new, okay? It's been around since 2001. It's called a 401k plan. Now, many of you worked at jobs where you had a 401k, which was very nice because your employer put money in, you put money in, and it was all deductible, and that's wonderful. Well, when you become self-employed, you're your own boss, so nobody's going to take care of you. Do you know that 95% of all Americans who are presently retired today, 95% of them are financially dependent every month with the help of a check from Social Security, Medicare, their church, or their children? Well, when you retire, are you counting on Social Security to help you, or your church, your children, or welfare? No. You want to depend on yourself. Okay, so for $160 a year, you can have your own solo 401k. I don't sell them. I don't get a kickback on them. I have nothing to do with 401ks, except that I happen to have one myself, and that's how I know it's $160 a year. Now, you can pay more. You can pay $1,000 a year and have another one, but the one that I use, the one that I like, is $160 a year, and like I say, I don't get any kickback. Now, this solo 401k is a qualified plan. If you have a SEP or an IRA, those are unqualified plans. Would you like to know the difference?
Yes.
Only the qualified plan is 100% protected from lawsuits, creditors, and bankruptcy. Only the solo 401k. Now, you can have a DB plan, but we won't go into that. Now, the other plans are not 100% protected from lawsuits, creditors, and bankruptcy. Number two, with a solo 401k, you can usually put more money into it because you're allowed to put in 20% of your net earnings from real estate, including that Airbnb. And you're also allowed to add an extra about $20,000, $19,500, something like that. Okay, so on 20% plus an extra 20,000, let's say. And best of all, at any time, for any reason, you can take loans from your solo 401k and use the money for anything you want. Now, you folks out there that are men, I don't want you going out and using money from your solo 401k to buy a motorcycle or to go, or a boat. Don't do that. No. Women would never do that, but men think about it sometimes. Okay. Or you can do like I do, you can borrow money from your solo 401k to buy investment property. When my younger daughter, Macarena, you heard about earlier, my younger daughter, Gia, went to law school up in Baltimore, I bought a little townhouse up in Baltimore back in 2001 for $135,000 with a great real estate broker, helped me find it. And she was there for 3 years. She graduated very, very honors, and she was the youngest one in her class and all that. And guess what? When she finished and moved back to Bethesda, I sold it for $210,000. So if I hadn't been able to borrow the down payment from my solo 401k, I would have just paid rent checks for those 3.5 years that she was up in Baltimore. So what happened? I bought it for $135,000. I sold it for $210,000. I made a nice profit that covered all of her law school. My son was in law school at the very same time, but he got a full scholarship. Thank you, Preston. That was wonderful. But in any case, you can borrow from your solo 401k. Now, if you want to take the money and go to Las Vegas, or maybe Jennifer and I want to go to Turks and Caicos, where that background is.
Yes.
Or St. Martin, so we can make some perfume together. But in any case, I would advise that if you want to take money out of your solo 401k as a loan, then you can do so. and you can use it at any time for any reason. Now, if you're just taking the money out to buy an investment property or for any other reason, maybe you have to pay some tax bill or maybe credit card bills. I don't like that, but if you had to, you need to pay it back over 5 years and the interest rate is 5%. But if you borrow the money from your solo 401k to buy your own home, your primary residence where you're going to be sleeping and everything, then you have a 15-year payback at 5% interest. So that's very nice. Now, if you were to take money out of your SEP or your IRA, it's fully taxable. You're going to pay federal tax, state tax, and usually you're under 59.5, you're going to pay a 10% penalty. Yikes. Okay. Whereas if you take money out of your solo 401k, it's a loan. There's no tax to pay, and you continue to pay yourself interest, which goes back into your solo 401k. So you still have the 401k, it's making money, and then your money is working for you at buying a rental property. And you're allowed one, yes, more than
Love
yay,
that.
fabulous, double yay. So a solo 401k, if you need any questions, I'll refer you to, like I say, I don't sell them, but I use Mark Moninger, and he's my certified financial planner. Do not buy any retirement vehicle of any kind, investment, unless it's from a certified financial planner. Okay, don't trust anybody else. So I'll refer you to mine if you send us an email on our website. But or you can look up Mark Moninger. He's here in Rockville, Maryland. He's done my solo 401k for 20 years, ever since it was invented. And I've sent him hundreds of people.
I was going to say, let's go ahead and tell people your, I just realized I should have pinned to the top of the room. I'll do that in just 1 second. I will pin. Go ahead and tell people your contact information if they wanted to call. And also one of the things, talk a little bit about before we run out of time. I know that you will also do a review of like the past 2 years of someone's tax returns and see, you take out, I love when you actually do this. You take out your red pen and you circle all of the deductions that someone missed and how much money they could have saved. And you do that for free, right?
Yes, I will do it personally for free. After April 15th, as you know, right now it's March 15th of 2022.
Yeah, exactly.
But after April 15th, I would be happy to. I would advise everybody to go on extension, because if you haven't gotten all your material together by March 15th, then do it before, you can do it before October 15th. That's all that matters. But if you think that you're going to owe any money on April 15th, go ahead and pay that no matter what. Because if you're going to open up a 401k, you still have time. I forgot to mention, with a 401k, you don't even have to put the money in until October 15th of the following year. So I have many clients right now who made good money last year. Real estate was booming, and they're going to owe money. So we're having them pay at least the federal tax, and then they're hoping to save up more money before October 15th. And then if they put it into their solo 401k, that's going to reduce what they were going to owe, and because it saves them money dollar for dollar. And if you want to reach us, our company name is Tax-Masters, and we're in Rockville, Maryland. And you go, our website has lots of free information. There's free checklists of deductions for your car, your office and home, all the realtor deductions that you folks who are realtors could need, or anybody, business deductions if you're self-employed in any way. And you'll meet our team. There's 20 of us in our office. Everybody in the office is smarter than me, so you don't want me. I just talk and teach about it, but everybody else actually knows how to do it.
Well, and I know, because we all call and say, I want Linda, because I heard Linda on TV or on radio and stuff. But I went ahead and I pinned to the top of the room. I know we only have a couple more minutes before we're going to be out of here, but I pinned to the top of the room, Tax Masters. It's tax-masters.com at the top of there. So you can get the her website there, and you can send emails if you want the free review. Remember, after April 15th, because it is the middle of the tax season, it is super busy right now for most tax accountants. And I'm so grateful, Linda, for you being here. I wanted to go ahead and ask John Lee. I know usually you have a great question. I know John, Linda, do you have any questions for Linda today?
Yeah, thank you, Jennifer. Just a quick one. And thank you for having Linda back. Always great. You always have such great guests, but Linda is always so good hearing from you, and you're so knowledgeable. I've already got a whole page of notes. It's not even 8 a.m. here, so I really thank you for that. I just got one quick question. You were
about meals going up to 100% in 2022. Will that also include entertainment? Because I know I used to group them together, meals and entertainment. That's how I kind of look at it, because I used to have like season tickets for baseball and use them for business and things like that. So that's my question. Thank you.
I have bad news for you, John. It used to be we could deduct tickets for entertainment, you know, if you go to shows or you men like to go to sports events. Unfortunately, entertainment is no longer deductible. That one changed a few years ago, but the actual meal is deductible. So let's say you take your friends to a sports event, but while you're there, you buy them some beer and hot dogs and peanuts or whatever you buy at the football game or the whatever game it is. You can deduct all of the food, assuming that while you were chewing the food, you were talking about business, which I'm sure you were. Then the food would become deductible, but not the actual cost of the tickets. I'm so sorry.
Go
Does
ahead,
that
John.
help?
Did you have something else? But all the other expense, like other meals and going out for coffee at Starbucks with business people, associates, all of those are going to be the 100% deductible for this year, for 2022, right?
Yes, and we don't know what's happening in the future because anything could happen before December.
Right. It is a very interesting time. Well, I know we're at the 9 o'clock hour here in the Eastern time zone. And I wanted to just check, is there anybody else in the audience who had a question before we go ahead and say goodbye to Linda, or on the panel? Anybody up there? Lily? Oh, go ahead, David. Do you have something?
Yeah, just real quick, the home office deduction, we do that for LLCs. Do you know if you can do the home office deduction when you've created a C corporation?
Okay, what happens with the C corporation is you will reimburse yourself for the percentage of the expenses on your home. So if it's 6% use of your home, then 6% of the utilities and the homeowners association fees and the condo fees and the insurance on the house and the repairs, you'll just reimburse yourself for those. So it is deductible. It just requires a little more bookkeeping. Like all C corporations require more bookkeeping, but of course you're going to hire a bookkeeper to keep track of it, right? Because you don't want to do it. Your time is too valuable. Right?
Exactly. Well, thank you, David. That was a great question. And thanks, John. Thanks, Lily, for being here. And thanks, Tom. And thanks, everybody who's in the audience. You guys, let's see, there's Kevin, all you guys. I am so grateful for all of you being here. And again, we'll have this on replay. We'll play it back again. And Linda, you are the tax master for sure. Thank you. Yay. She's throwing up $100 bills. And of course, her magic wand. Yay. We want you to save money, save money. So I'm going to go ahead and as I say, everybody who's up on stage, if you will come off your mic and let's end the room with our yay, our famous yay, and then I will close the room down. So 3, 2, 1, yay!
Yay, Jennifer! Yay, Jennifer! Love you, darling. Thank you.
Thank you, guys. Thank you, thank you, thank you. Let's do, we're going to do hold on one second. Oh, we got